Okay, so now for part 2 here, picking back up with learning objective number 5. So now that we've talked a little bit about the risk assessment, and we've talked a little bit about materiality, how now can we influence, or how does that impact um, the audit? So how is that going to impact the way in which we perform the audit? Okay, so when we're assessing the risks, overall we're thinking about what could go wrong, um, and in terms of the financial statements. So, for example, we could have revenue that is invalid, right? Transactions that are made up. How likely is it, though, that that will go wrong based on our evaluation of the risks, um, the inherent risk, the control risk, possibly the detection risk, and then what are the likely amounts involved, right? So that's kind of getting to how large is the account, what's the possible amount of misstatement. And yeah, like I mentioned, inherent risks we would consider. Specifically, we'll also look at fraud risks, which we'll talk about here in a few minutes. And we always assume there's going to be a risk of material misstatement regarding revenue. It's a top line income statement amount. And so, and revenue recognition misstatements are the most common. For example, if you look at the restatements that are issued, the most common reason for restatements is because of revenue recognition. So once we identify those significant risks, then we're going to have to think about that's going to impact how we do our testing. And so obviously, if revenue is a significant item, then we're going to have to consider the internal controls around revenue, making sure it's recorded correctly, making sure there's validation or valid transactions. If we identify the account as having a significant risk, then we can't rely on controls from prior periods, and we can't only do analytical procedures, right? There are some accounts that don't have a significant risk where we could rely on controls in prior periods, possibly, assuming there's no changes, and we could just use analytical procedures. So imagine like a small item on the income statement, some kind of expense that doesn't have a lot of materiality to it. And then once we kind of identify all the risks, then we design all the audit procedures. So then looking at learning objective 6 here, we've got how auditors address fraud risk. And this is kind of assumed by a lot of the public, right, is that our job is to find fraud. And while that's true in some regards, there are limitations around it. So let's understand a little bit more in terms of how auditors deal with this risk of fraud. So obviously we need to assess it first. So that's part of our risk assessment procedures. And so we think about two different types. You can manipulate the financial statements, or you can steal assets or misuse them. Right? Those are the two kinds of frauds. And so what are we going to do to assess specifically the fraud risk? Obviously, the auditor's engagement team will try and think about ways in which fraud is most likely, right? So you tend to have you're supposed to have these brainstorming sessions where you're just thinking about possible manipulations, right? Possible frauds that they could be engaged in, just to get them out there and get you aware, right? We'll talk to management and we'll talk to other personnel. Obviously, if someone's engaging in fraud, they're not going to tell you they're engaged in fraud, but we'll still talk to them about these possibly some of these different areas that could result in fraud. We will use risk assessment and analytical procedures. Again, fraud risk is just a specific kind of risk that we have to kind of highlight. Even though we're doing a lot of these other things in our general risk assessment, we're just going to elevate kind of our procedures that directly are related to fraud risk, even though they might mirror a lot of the other procedures we're already doing. And so analytical procedures are just another example. And then, depending on whether you've seen this in your accounting information systems class or not, we'll consider the fraud triangle, right, which is essentially incentives, opportunity, and attitude, rationalization. Rationalization. It used to be called ethics. This third stool or third side of the fraud triangle, and essentially, right, we're going to look for what are the incentives of managers to engage in fraud. Um, that'll be things like stock options and pressure from analysts and meeting earnings forecasts and all these things. Um, we'll look for opportunities. A lot of that is related to the complexity of the transactions, the strength of the internal control system, um, the number of unusual transactions that might be there. And then lastly, thinking about, which is the hardest one to evaluate, which is their attitude around fraud or the ability to rationalize. And so a lot of times you'll look at things like tone at the top, right? What kind of messaging is sent out from the executive team in terms of what they view as important. You know, if the only thing they care about is stock price, right? Like um, Enron was like this. You would have kind of the, you know, those scrolling ticker tapes with stocks and stock prices. They would have those throughout their headquarters, right? I think even in the elevator, they would have these rolling, you know, monitors that basically tell the stock price. And what's the message there? The message is you make sure that stock price is high, right? You make sure that stock price goes up. And so you would have to look at other things around culture to try and deal with this last piece. So how do we respond once we've assessed kind of the likelihood of fraud risk? How do we respond in terms of if we think there is a heightened fraud risk, what do we do? Well, you increase your skepticism, right? You're going to make sure that you're getting evidence for everything, that you're not relying just on inquiry for if they give you some assertion, you want some evidence to back it up. You want to make sure that evidence is good quality evidence. You're going to have to assign more experienced individuals on the audit. Probably have more hours for managers or senior managers or partners. You're going to look more closely at the accounting methods to see are they trying to manipulate those methods in order to gain some benefit on the financial statements. And you're going to have to vary your audit procedures, right? So it's kind of like a cat and mouse game where if you've always sampled a certain number of transactions from a certain part of the year that are over a certain dollar amount, you're going to have to mix that up. You can't just keep doing the same thing year to year. And then what are you going to need to do as far as the audit evidence goes? I alluded to this a little bit already, but you need to vary the nature, the timing, and the extent, right? Those are these 3 bullet points. So the nature is the reliability of the evidence, so you're going to need more reliable evidence. The timing is when you're doing your audit procedures, so you're going to wait till year end to do more of the work because you don't want them to have that opportunity to manipulate from interim testing until year end. And then you're going to have to increase the extent, right, in terms of having larger sample sizes in order to get more comfort around the financial statements. And then management override is a particular type of possible fraud. And so what might you do there? Well, you're going to be looking for journal entries where managers are the ones that are actually doing the journal entries as opposed to the normal individuals. You're going to be looking at those estimates and certain accounting methods, look and see if there's any bias in the estimate, right? If they have depreciation and they've changed depreciation the number of years to depreciate an asset to be longer, then you're going to review that and say, okay, is that really true, or is that just bias? They're trying to put it in there to make the denominator bigger, which makes the depreciation every year smaller. And then you're going to be looking for reviewing these significant unusual transactions as well. Okay, so you're going to be thinking about fraud throughout the audit. Also evaluating the results of the audit test. If you discover fraud, obviously So let's say you find a lower level individual that you think is manipulating the reporting that they're sending higher up into the firm, then you're going to go above them and start reporting it to the higher levels of management. If it's senior management, then you have to talk to the audit committee, right? So, and if it results in a material misstatement, you also need to talk to the audit committee, right? So it's possible you can find fraud, but it's immaterial, and that's where you could you might not have to talk to the audit committee right away, but chances are if it's fraud, you really need to, um, depending on the nature of the fraud. Now, obviously, if you have a low level employee that's taking extra supplies, right, you probably don't need to take that all the way up to the audit committee. So there's some judgment there, but um, this is a little graphic I created just to think about what are the different reasons why we could have material misstatement, right? And it starts with kind of and these kind of increase in risk. So errors are just calculation was wrong, estimate was wrong, you applied GAAP incorrectly because you didn't understand it. That's what that these are increasing in fraud risk. I should say, unintentional bias, right? So there's evidence that shows managers are just more optimistic than the average person, right? MBA students are just more optimistic usually than other students, so they think they're better than they maybe are in terms of a certain attribute. And so it could just be that they're optimistic, and so they've unintentionally inserted some of that optimism into the financial statements. You can have disagreements in the application of GAAP, like they don't agree with how GAAP should be applied, and so, for example, revenue recognition, they may think that they've met the threshold to recognize revenue, even though the auditor thinks that they haven't, right? And that's not bias, it's not error, it's just we disagree. We think that our way of doing revenue recognition is better than what you're saying as the auditor. But it's obviously an intentional kind of choice, and that's why this is higher than the other two. And then you can have intentional bias where you're intentionally trying to have the most favorable estimates that are still within the reasonable range, but maybe that are on the high end of what's reasonable, right? And so they're kind of trying to inject some intentional bias. And if they take that too far, they take it outside of the reasonable range, that's where we can get into fraud, right? Fraudulent reporting or misappropriation of assets. So all of these are potential sources of the risk of material misstatement. So just keep that in mind. And we're going to try and design our procedures as a way to handle all these. But they still exist as potential sources nonetheless. Okay, so moving on to Objective 7, how auditors design further audit procedures in response to these assessed risks, right? So talking about risk assessment, we've talked at least generally how they could impact audit procedures. Now let's think a little bit more fully into how they design the audit procedures. Okay, so we have different types. We have analytical procedures, which can be done up front in the risk assessment or planning stage. We have control testing. We have and tests of details of transactions and balances. Right, those are three kind of audit procedures. Control testing and test of details can both make use of data analytics. And remember the difference between the analytical procedures and data analytics. Analytical procedures just use kind of financial statement level information, right? Account balances, whereas the data analytics uses transaction level data in order to do testing. Okay, and we'll talk more about that as we go throughout the course. And then specific procedures you can use for control testing or tests of details and transactions. You can actually use analytical procedures for the test of details if it is or test of balances rather, if it's a low risk account, right? You can also do things like inspection. Let's say you're trying to inspect inventory, for example, to see do they have inventory that's gone bad, for example. Observation, you can observe controls that are being executed, that are being performed. You can talk to managers and key personnel. We'll use confirmation. Usually when we say confirmation there, we mean confirmation with an external party, right? So a customer or possibly a bank. Those are different kinds of confirmations we can do. We can recalculate if a given method, and we can reperform certain actions, right? Like a bank reconciliation, for example. Those audit procedures always have to include substantive procedures for all material relevant assertions. So you'll see this more in practice as we kind of work through the different transaction cycles. But let's say we have an assertion around completeness, and we think that we're worried about completeness for accounts payable, for example. It's a liability. And so we're going to have to do substantive procedures for that assertion around completeness for accounts payable. Control testing we will do. So if we have to do an opinion on internal control testing on internal controls, then we'll always do control testing, right? If we're not doing that opinion, possibly like it's a private firm, for example, privately held firm, then we do that when the risk assessment expects controls to operate effectively. So basically, there's a good design, and so if there's a good design, then we'll want to go ahead and do the test of controls to make sure it's operating effectively. And so remember we talked before about the trade-off between control risk and detection risk, and that's part of the art of playing in an audit, is how much of the controls do we want to test in order to reduce some of our other substantive procedures. And every audit procedure should be linked to an assertion for a given financial statement account, right? We shouldn't just have generic procedures that we're just doing. They should all be linked to an assertion which is connected to the risk of material misstatement. And so if we have overall high level or high risk of material misstatement, so it's similar to when we had a high fraud risk, right? Fraud is just a specific kind of risk of material misstatement, but this is just in general, this is going to be our approach when we have a higher risk of material misstatement. So same things apply. More professional skepticism, more experienced staff, specialized skills with staff, and having more supervision, right? So same kind of response. If we look at audit documentation, we're going to have it in the different phases of the audit will have its own set of documentation, right? So if we're doing the risk assessment, then we'll talk about that discussion by the audit team. We'll have to document that. We'll have to document their auditor's understanding of the firm. I have to document the assessed risk of material misstatement and the risks that are identified, right? So all that is going to have to be documented for risk assessment. When we actually execute the procedures, same level of detail, right? What procedures are we doing? What's the nature, the timing, and the extent of those? How do those connect with the risks that we identified earlier? What are the results, and then what are our conclusions from it? And to what extent we need to complement some of the procedures that we've done with additional evidence. And then lastly, again, fraud is just an area where we're kind of highlighting our procedures that are specific to fraud, as opposed to those other areas of misstatement, right? As opposed to errors or bias. And so we're going to document the same things that we documented before in terms of what risk are we identifying, what our response is, have we communicated that, right? All that we're going to have to document. So the audit trail is you can kind of think about it as a pathway through the accounting cycle. If you remember the accounting cycle from your kind of intro classes, right? So how can we go from source documents all the way through the journals, the subsidiary ledger, the general ledger, to the financial statements, right? How can we make it all the way through there? And so we can kind of go two different ways in terms of following the trail, and they impact two different assertions. Let me and I've mentioned how these two are connected before. That's existence and completeness. Okay, and so if you think about how the source documents go to journals and ledgers and ultimately to the financial statements, so depending on where we start and where we go dictates which assertion we're testing. So if we start with the ledger, so for example, we want to look at revenue, right? We're going to start there, look at all the revenue transactions or all the postings in the ledger. Then we trace it back to the sales journal, for example, to look for the individual transactions, and then we go from there for each transaction or a sample of transactions back to the source documents. If we do that, we're testing for existence, right? So is the balance in the ledger, is that a valid balance? And usually when you talk about existence, we're talking about overstatement. So is that overstated? Well, the way you find that or confirm it is you go back and see, well, do I have transactions listed for that balance? And then go back and do I have documents that provide evidence that those transactions are legitimate, right? So going back is existence and is for overstatements. Going forward is completeness. So if I start with, for example, a set of receiving reports for inventory that I've ordered, I start there and then I go and make sure it's recorded along with the invoice. When I get the invoice in, I make sure that's recorded in the purchases journal. Or excuse me, if I start with an invoice, or excuse me, a purchase order, and then I go to the purchases journal, ultimately I get the invoice in, make sure that that matches up along with the receiving report, right, before I book it into as a liability. And I'll look at that in the purchases journal and then go from the purchases journal to the ledger for accounts payable. There, I'm looking to make sure I'm not losing anything, right? I'm looking for completeness. Did all of my inventory that I purchased, did that get booked as a liability? Ultimately, that shows up in the AP balance in the general ledger, right? And so there, I'm looking for understatements. I'm looking for any source documents that didn't flow all the way through to the balance in the general ledger. Okay, so those are two different directions of testing, even though they use similar. Both of them use ledgers and journals and source documents. The population you start with differs, and so therefore it impacts the assertion level you're actually testing. And we're going to be looking at the transaction cycles. We're going to walk through internal controls and also walk through substantive testing for each of these transaction cycles, or at least most of these transaction cycles. If you look, so here's just an example. If we looked at the revenue cycle, right, we'll see accounts receivable as a significant account, right? And we'll also see how this relates to the sales number, right? If these are for credit sales, for example. Right, so this is for credit sales. The credit in here would be related to cash received from customers, right? We could also have some sales returns and allowances on collectible accounts, right? So looking at this transaction cycle related to sales, we can also get comfort around what's going on from the balance sheet perspective. And so we'll kind of see this. We're going to walk through the different balance sheet items, but at the same time we can also get information around the different transaction cycles as we're walking through the balance sheet. Okay, so last learning objective here, understand the difference between the systems and substantive procedures portions of the audit plan. Okay, so the systems portion is usually around obtaining understanding, focusing on internal controls, and so you're going to have an initial assessment of control risk, and you're also going to have, once you actually execute the internal controls, you're going to have results from those test controls. So that's kind of considered the systems portion. Substantive testing portion is when you're actually focused on the financial statement balances. And so there you're going to be doing your test of details of transactions and your test of balances. So that's where we're going to actually get to accuracy of the numbers that are on the financial statements. And so we can get to this, just like that example we gave a second ago around accounts receivable. You can have similar, or you can have procedures that can get to the activity within the account, and you're also going to have activity, or excuse me, confirmation around the balances of certain accounts as well. So if you look here, for example, here's indirect verification of income statement accounts. So, right, there's some things we can do. So, for example, if you look at revenue, and you've got just the idea that if you if you flip around the accounts receivable debits and credits, you can get to this. You can basically find revenue. You can use some algebra. Find revenue by taking cash receipts from customers minus. It's either minus beginning balance of AR plus ending balance, or another way to say that is plus the change in AR, right? Because that's just ending balance minus beginning balance. Okay, so that's just the algebra there. If we have these different components, right? Beginning balance, we can look at last year's working papers. If you look at the ending balance, we'll talk about some ways that we can actually confirm the ending balance based on some testing, specifically things like confirmation. So we can confirm this ending balance of AR, and we can also then test our cash receipts from customers and reconcile the cash accounts, and then that gives us an indirect way to confirm the amount of revenue, right? And so we can do as a direct verification of revenue, and that would be walking through, for example, all the sales orders and making sure those sales orders are making it all the way into the revenue balance, and vice versa. We can look at the revenue balance and then go backwards and verify everything is substantiated by a sales order. And so there's two different ways, right? This indirect verification and direct verification we can have. And so that's just one example of revenue, but you can think about it for the others as well. Okay? And so you can kind of think about these as like different ways to triangulate comfort around income statement items. Okay, and so then if we look at relationship of financial statement assertions to the audit, we got the financial statements. Management has a set of assertions. Those are those 6 assertions we talked about before. And we're going to come back to these over and over again when we get to the actual testing that we do in later in the third portion of the course. And an audit objective is basically just an assertion applied to a specific account. So completeness for accounts payable becomes an audit objective. Okay. Then once we have that objective, then we design our procedures based on the risks, and we collect evidence from those procedures. We summarize that evidence, come up with a conclusion. Do we feel like the account is fairly stated? And that ultimately goes into how we create a report, right? And so this is just kind of how the financial statement assertions work their way into the audit process. And this is, again, one of these nice summary, although this was a little bit of a summary, but a little bit of examples, really a set of examples here for how we can have an assertion tied to an account, and how that creates an audit objective thinking about what could go wrong, and then what can we do as an audit procedure to um, give us some assurance that what could go wrong didn't actually happen. So right, so if we look at existence, that's an assertion. We look at AR to come up with a specific audit objective. So in that case, all recorded receivables exist. Right, they don't just have an asset sitting on their books that doesn't exist. So what could go wrong? Well, you might have some that are recorded that don't exist, or you may have some fraudulent revenue as well. Okay, and so what can we do to deal with that? So one could be error, that could be fraud. So one example is we do a confirmation of receivables by talking to the actual customers and say, hey, do you owe this amount to this company? And we can also look for adjusting entries related to these accounts as well. Okay, so this is just again, an example, a set of examples for these different assertions and how they would tie into one account, which is accounts receivable, to come up with specific audit objectives. And we're going to go through these in more detail for sure as we go through the different chapters and sections.